At 94, Warren Buffett just made a move that shook Wall Street. He sold off billions in investments that many financial advisors still recommend to people over 60. But here's the surprising part, Buffett isn't following the usual retirement advice. And if you're near retirement or already there, what he's doing could completely change how you see your money. Most people think Buffett just gradually changed his investing style over time, but after he turned 60, his strategy made a huge shift, not because he became afraid of risk, but because he realized that what many call safe investing after 60 is actually the most dangerous. While your advisor might be telling you to buy more bonds, spread out your investments, and rely on dividend-paying stocks, Buffett's doing the opposite. In fact, he actively avoids three types of investments that many people still have in their portfolios, and at least one of them could be quietly hurting your financial future without you even realizing it. The first one: long-term bonds. That's right, the same ones advisors say are the backbone of a safe retirement plan. But Buffett strongly disagrees. He's called long-term bonds terrible investments for older people. Not just risky, terrible. And when someone with Buffett's experience uses words like that, it's worth paying serious attention. Let me tell you exactly what Warren Buffett said in his 2021 shareholder letter: bonds are not the place to be these days. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. That's not coming from some random YouTube personality, it's from a man who built a $100 billion fortune. So why is Buffett so strongly against something most people consider safe? Because he understands something most people completely overlook. When you buy a 30-year Treasury bond at 3%, you're making a big bet that inflation will stay under 3% for the next 30 years. But history shows that's a risky assumption. Over the last 50 years, inflation has gone above 5% many times. In the 1970s, it averaged over 6% and even hit double digits in some years. More recently, in 2022, inflation rose above 9%. In those times, your safe 3% bond ends up losing purchasing power year after year. Let's look at a real-life example. My neighbor Jim bought $100,000 in 30-year Treasury bonds in 1990 with an 8% yield. Sounds solid, right? But by 2020, that $100,000 could only buy what $60,000 could back in 1990. Even though he got all his interest payments, he still lost 40% of his buying power. Now, here's what Buffett does instead, and it's a smart move. Instead of locking in low returns and slowly losing money to inflation, he puts his money into companies with what he calls pricing power, businesses that can raise prices without losing customers. Let's talk about the kinds of companies Buffett actually invests in, like Coca-Cola, Apple, American Express, and See's Candies. Picture this: in 1988, when Buffett started buying Coca-Cola stock, a can of Coke cost about 50 cents. Today, that same can costs around $1.75 in most places. Coca-Cola didn't just keep up with inflation, it beat it. Buffett's investment in Coca-Cola grew from $1.3 billion to over $25 billion. That's not just about protecting against inflation, it's about growing real wealth. And here's the key takeaway: after age 60, Buffett realized that your biggest financial threat isn't the ups and downs of the stock market, it's inflation quietly eating away at your money. Bonds won't save you from that, they make it worse, giving you small fixed payments while your money loses value over time. If these ideas are shifting how you think about retirement, type "eye-opening" in the comments below. I want to know this is helping you. Now let's look at investment number 2 that Buffett avoids: broad index funds. This one might surprise you. We're talking about S&P 500 index funds, the same ones that nearly every financial influencer says to just buy and hold. Now here's where it gets interesting. Buffett has said most people should invest in index funds. He even bet $1 million that index funds would outperform hedge funds over 10 years, and he won. So why does he avoid them? Because there's a big difference between what Buffett recommends for the general public and what he does with his own money, especially after age 60. When he talks about index funds, he's giving advice to people who don't have the time, interest, or skill to study individual companies. For them, owning tiny pieces of 500 companies is smarter than trying, and failing, to pick winning stocks. But Buffett himself has never followed that advice. He's always done deep research and bought individual companies he understands well. And as you get older, that kind of focused investing becomes even more important. Not at 30, not at 60, and definitely not at 94, Warren Buffett's portfolio at Berkshire Hathaway has never looked like an index fund. Right now, just 5 companies make up around 75% of his stock portfolio, with Apple alone making up over 40%. That's not spreading risk wide, it's putting money where he has the highest conviction. And this becomes even more important after age 60. When you're 30 or 40, you have time for average results. Index funds give you average market returns, and over 30 or 40 years, that can turn into a solid amount. But when you're 60 or 65, you don't have decades for average to pay off. Let me explain with numbers. The S&P 500 averages about 10% annually over the long term, but that includes some terrible stretches, like from 2000 to 2009, when it actually lost money. If you were 60 and retired in 2000 with your money in index funds, you would have seen your savings shrink for nearly 10 years. And if you're 65 and need to start using that money, you can't wait for a slow market comeback. You need your investments working efficiently right away. That's why Buffett's strategy of focusing on a few great companies makes more sense as you get older. Instead of betting on 500 different companies and hoping for an average return, he chooses companies with huge advantages, ones that grow earnings steadily, no matter how the market is doing. Look at Apple, his biggest holding. Since he began buying it in 2016, Apple has returned over 400%, compared to the S&P 500's 100% return during the same period. And Apple's not a risky bet, it's one of the most cash-rich, profitable companies ever. The key lesson here is that after 60, you can't afford average returns. You need your money working harder and smarter from day one. That might mean holding fewer investments, but making sure the ones you do own are solid, dependable, and built to last. Now let's talk about the third type of investment Warren Buffett avoids, and this one might surprise you. It's high dividend stocks, yes, even those popular dividend aristocrats that have raised their payouts for 25 straight years or more. If you're like most people nearing retirement, you've probably heard that dividend stocks are perfect for you. They offer steady income, consistent payments, and peace of mind. But Buffett sees them completely differently, and his reasons might completely change how you think about income. Here's a surprising fact: Buffett's company, Berkshire Hathaway, worth over $700 billion, hasn't paid a single dividend since 1967. That's more than 55 years without giving shareholders a penny in dividends, and yet, if you'd invested $10,000 in Berkshire in 1967, it would be worth over $300 million today. So why doesn't the world's most successful investor like dividends? And why should that matter to you? Because Buffett understands something most people miss: how taxes and compounding work together. The truth is, every dollar a company pays you as a dividend is one less dollar it can use to grow the business. Now, if you need that money to live on, fine, but if you're just going to reinvest those dividends, you're actually hurting yourself. Let's break it down. Imagine a great company pays you a 4% dividend. That's taxable income, so if you're in a 20% tax bracket, you only keep 3.2%. Then you reinvest that money back into the market. But what if the company had kept that 4% and reinvested it itself? If they can earn a 15% return on it, as great businesses often can, your shares go up in value without you paying any taxes until you sell. Buffett calls this tax-deferred compounding, and it's one of the most powerful ways to build wealth. When companies grow your money inside the business, you avoid taxes and let compounding work uninterrupted. It's a smarter, more efficient way to grow wealth, especially after 60. The third investment Warren Buffett avoids is high dividend stocks, and this might surprise many people, especially those close to retirement who believe dividend stocks are perfect for them. These are the companies that have increased their dividends for 25 years or more, often called dividend aristocrats. Most people are told that these stocks offer reliable income and are ideal for retirees, but Buffett completely disagrees. And his reasons could change how you think about income forever. Here's something that might shock you: Buffett's company, Berkshire Hathaway, which is worth over $700 billion, hasn't paid a single dividend since 1967. That's more than 55 years without giving shareholders a single payment, and yet, if you had invested $10,000 in Berkshire in 1967, it would be worth over $300 million today. So why would the world's most successful investor avoid dividends? Because he understands something about taxes and compounding that many people don't. Every dollar a company gives you as a dividend is a dollar it can't use to grow the business. If you need that money to live on, that's okay. But if you plan to reinvest it, you're actually hurting your returns. Let's break it down with simple math. Say a company pays you a 4% dividend. That income is taxed, so if you're in a 20% tax bracket, you only keep 3.2%. Then you reinvest that money, but you've already lost part of it to taxes. Now imagine the company kept that 4% and reinvested it into growing the business. If it earns a 15% return on that capital, which great companies often can, your investment grows faster and you don't pay taxes until you sell. That's what Buffett calls tax-deferred compounding, and it's one of the most powerful tools for building wealth. Instead of getting small, taxed payouts, your investment keeps growing inside the company, untouched and untaxed, until you choose to cash out. It's a smarter way to build wealth, especially later in life. Would you rather take a 3.2% after-tax dividend or let your shares grow by 15% with no tax bill right now? Most people might say, but I like getting that dividend in my account every few months, it feels good and secure. And that's totally understandable. Dividends give a sense of comfort, like a financial safety net. But Warren Buffett realized something important: just because you're getting income doesn't mean you're actually building wealth. In some cases, it might be slowing you down. Take Apple, for example. It pays a small dividend, only about 0.5% a year, but that's not why Buffett owns it. He loves Apple because the company makes huge profits and reinvests those profits wisely. In the past 5 years alone, Apple has spent over $400 billion buying back its own stock. That means Buffett's share of Apple's profits keeps getting bigger without him needing to pay taxes on it. Share buybacks are powerful because when Apple reduces the number of shares it has, each remaining share becomes more valuable. It's like getting a dividend, but instead of cash you pay taxes on, you get more ownership in the company, tax-free. The problem with dividend investing is that it makes people feel like they're making smart moves, when they might actually be missing out on bigger growth. You see a dividend hit your account and think, nice, my investments are working, but in reality, you might be trading long-term wealth for short-term comfort. Buffett's strategy is simple: let great companies grow your money inside the business, without triggering taxes. Then, when you actually need money, sell a bit of your stock. That way, you pay the lower capital gains tax and have a much larger pile of wealth to draw from. If you've ever been told to buy bonds for safety or dividend stocks for income, you're not alone. These ideas have been repeated for years, but they don't always serve you best. Share your own experience in the comments, it might help someone else rethink what they've been told. Because as we've just seen, many popular retirement strategies, like relying on bonds or chasing dividends, might actually be holding you back. Index funds might seem fine, but after age 60, they're more like a safety net for average results than a real wealth-building strategy. And dividend stocks? They're not really reliable income, they're tax traps that just feel safe. I get it, this might sound strange or even uncomfortable because it goes against everything you've likely been told for years. But here's the key idea that connects all three investments Buffett avoids: they're built on fear, on playing not to lose. And after 60, playing not to lose can actually cause you to lose. Traditional retirement advice says to get more cautious with age, move from stocks to bonds, diversify a lot to avoid losses, and chase dividends so you can see your returns. But Buffett saw something most people miss. After 60, the biggest risk isn't a short-term market drop, it's running out of money later in life. And all these so-called safe strategies almost guarantee you'll lose purchasing power over time. Buffett shifted his mindset and it made all the difference. Most people think retirement means they've made it, they saved enough, and now they just need to protect it. But Buffett realized retirement isn't the end, it's a whole new chapter that could last 30 years or more. At age 60, you're not planning for 5 years, you're planning for potentially 3 full decades. And that's more than enough time for inflation to slowly destroy your buying power, even if it's only moderate. It's also enough time for you to see multiple stock market crashes and recoveries. 30 years is a long time, long enough for entire industries to rise and fall. So you have to ask yourself, do you want to spend those years watching your savings slowly lose value in so-called safe investments, or do you want to see your wealth grow alongside the world's most profitable companies? Buffett chose growth. Even at 94, more than 90% of his portfolio is in stocks. He's not sitting back collecting bond interest or dividend checks, he's investing in the future success of American businesses, and that choice has made him one of the richest people in history. What's most impressive is that he's not being risky, he's just thinking smarter than most. Rather than spreading his money across hundreds of average companies, he picks a handful of exceptional ones. Instead of settling for bonds that can't keep up with inflation, he invests in companies with the power to raise their prices. Instead of paying taxes on dividend income he doesn't need, he lets his investments grow tax-free inside great businesses. This way of thinking isn't about being aggressive, it's about being wise. It's about understanding that the strategies that helped you save money before retirement might not help you thrive in retirement. And it's about having the courage to make smarter choices even when everyone else is following the old rules. So, if you're wondering, if not bonds, index funds, or dividend stocks, then what should I do? Don't worry. What's coming next is a simple breakdown of Warren Buffett's real approach to investing after 60, boiled down into 3 principles you can start using right away. And the best part is, these principles aren't complicated, some of the most effective strategies never are. The first one. Ditch bonds and invest in businesses that can outpace inflation. Instead of lending your money to the government at low returns, own companies that can raise prices over time. Buffett calls this pricing power. Pricing power is like a financial superpower, and here's why. When Starbucks increases the price of a latte from $4 to $4.50, do people stop buying coffee? Probably not. When Apple raises the price of an iPhone from $999 to $1,099, do sales drop? The numbers say no. And when your electric company raises rates by 10%, you still use electricity. These companies can raise prices without losing customers because they offer products or services that people need, want, or can't easily replace. That's pricing power. And when you invest in companies like these, inflation works in your favor. As prices go up, profits grow, and your shares become more valuable. You'll usually find pricing power in sectors like essential utilities, dominant tech platforms, healthcare with patent protection, trusted consumer brands, and energy companies with limited resources. The trick is to look for businesses that offer something essential or hard to replace. Now for the second principle, focus on quality, not quantity. This can be tough because we're often taught that more diversification equals more safety. But Buffett's portfolio shows something different. 5 companies make up around 75% of his holdings. That's not random, it's a strategy. After 60, you don't need to invest in every company in the market. What you need are solid positions in the best businesses you can find. Look for companies with strong advantages that competitors can't easily copy, smart leadership that manages money well, and steady earnings even when the economy is rocky. Think of it like this, would you rather own 1% of 100 average restaurants or 10% of the 5 best ones in town? Owning fewer but better companies gives you more potential upside and more control over your financial future. I'm not saying you should put all your money into one stock, that's just gambling, not investing. But owning 10 to 15 carefully chosen companies is very different from owning 500 random ones in an index fund. When you have 10 to 15, you can really know what you own, understand their businesses, watch how they're doing, and make smart choices about when to keep them or sell. The third principle is to focus on total return, not just current income. This is where Buffett's smart tax strategy shines. Instead of taking dividends that get taxed like regular income, he lets his money grow inside the companies. This way, he doesn't pay taxes now, grows his wealth more, and controls when he turns that growth into money to spend. For example, if you need $50,000 a year, instead of buying dividend stocks that pay $50,000 and get taxed on the full amount every year, you could own stocks that go up in value and sell $50,000 worth each year. Dividends get taxed at ordinary income rates, maybe 22% or more, but when you sell stocks, you pay lower capital gains taxes on just the profit, not the full amount. So if you sell $50,000 worth of stock that you bought for $30,000, you only pay taxes on $20,000. Plus, selling stocks lets you be flexible. If your portfolio drops one year, you don't have to sell and can use other money until your investments recover. Dividend stocks might cut payments in tough times, which is harder to live with. The main point is Buffett's strategy after 60 isn't about being safer or riskier, it's about being smarter. Own good businesses, not bonds. Be focused, not scattered. Let your money grow before you spend it. And remember, at 94, Buffett is still thinking long-term. If you found this video useful, be sure to like, subscribe and turn on notifications to not miss our future uploads. See you in the next video.